In this episode, Jake and I discuss single premium non-MEC policies and how to get a relatively substantial amount of premium into policies rather quickly and correctly. We had fun and hope you enjoy listening. Welcome to the Bank of Life podcast. I'm your host, James Neathery. I'm excited because I have my youngest son, Jake, with me today, and I'm looking forward to a lovely conversation. Jake, how have you been? Where have you been?
I've been here.
World?
No, I've been here working.
Like show up every day and work?
Most days, that's right.
Most days he shows up. Yeah.
Look, I'll say I was sick for like 2 weeks and I showed up every day I was sick. Sorry guys if y'all got sick because
got
of that.
The whole office sick. But
it takes what it takes with business,
Sneaking in the back, doing the hand wipe on all.
Yeah.
Okay, so what we did talk the other day we talk every day. But we were talking the other day specifically about, the idea of trying to get all the money, a bunch of money into life insurance policies in like year one or as soon as possible. Yeah. And that was generally the concept and kind of where the conversation started, if I recall correctly. And then it just expanded out to a really lively discussion. And then, of course, we're like, this should be recorded. So here we are.
Yeah. We were kind of talking about what we were seeing in the big wide world. This is stuff we talk about quite often, is what we see out there.
Like every day, what you experience in and out.
Yeah.
Every day.
And one of the big issues that we see is oftentimes with, just beat up other agents and newer agents and stuff. But that's something that we see often is people maybe misremembering what Nelson says about certain subjects or maybe carefully editing.
Okay, you can be real nice about it. I'll be real straightforward, and I love agents. I have a special place in my heart for agents. However, if my position is, in my opinion, and you don't have to listen if you don't want, right? No, we have a lot of agents that listen. My position is if you are a life insurance agent or an advisor, financial advisor of some kind, then you should be worthy of that responsibility, which includes the knowledge of products. I'll kind of leave it there, but my point is there's a special place in my heart for agents, but you need to step up and deliver because this is not a game. Dealing with people's money,
their lives.
It's just so not a game. And I might have a good healthy dose of I'm over the gamification of the infinite banking concept. Yeah. And so Fair. It's like not very far under the surface. So you're being a gentleman, and I appreciate that. Somebody's misunderstanding, misconception, or they're trying to sell something, or maybe they don't understand it to the level that they should to quote unquote teach or promote.
Yeah.
Well,
we'll often see people with a large sum of money, and they take it to an agent, and the agent will try to put all of it into a policy year one. And they'll, max out a PUA, and they'll do, 95.5, right? A bunch of premium to the PUA.
Talking about
very
the
little
structure
base
of a policy.
That's right.
They're contorting the structure to accommodate,
a large premium, because people can't. Let's say, maybe I can pay $5,000 to $6,000 a year in premiums, but I have $150,000 sitting there. Yeah. Like you can't.
And my mortgage is $125,000 and I want to pay it off tomorrow.
Exactly. So what agents will often do is, just chunk all of that into a PUA, make the base what you can cover every year, and then everything else goes into like a SPUA or whatever. Like there's a bunch of different PUA riders out in the big wide world, but they'll put it into a PUA rider. Yeah. And it's just not the right way to do it. We were talking also about people talking about expanding their income or expanding their systems to accommodate all of their income. So specifically talking about everything I, earn, I put into a policy.
Yeah, and premium income should equal premium.
Yeah, that's common. We see that all the time out there. And what we often would say is like, you know what, you have all this money, you want to go spend that money, go spend the money. Don't just try to fit it, everything into a policy year one. That can harm a policy. That can, harm what you're trying to do with a policy 5, 6, 7, 10 years down the line.
It has results.
It has a negative result on the policy every time.
There's really a lot here, and we've already, before the cameras really started rolling, we've already sketched out a couple of upcoming topics, and one of them would be the misunderstandings or misconceptions, however it's titled. And there's a lot of them that are prevalent, and they're persistent, and they continue to exist within the infinite banking footprint, which is fine. It is what it is. But a broader story should be told. The whole story should be told, or at least available. Yeah. And so that'll come, and I'm sure that'll show up on one of the topics, that, and there's the least amount of death benefit. And I'm guilty. I said it 20 years ago, trying to get the least amount of death benefit, as much cash value. Well, that's, you can say it that way. Is it really correct? It would be more correct to adhere to Nelson, where he says de-emphasize the death benefit and emphasize the cash. That doesn't mean the least amount of death benefit possible at all, and then that extrapolated over time and across, the infinite banking footprint is what I call it. It's a misunderstanding. Yeah. And so it's somebody's misconception of Nelson's work, and then people grab onto that, and then they have their own misunderstanding of Nelson's work. And then, because I could go on and I could talk for 2 hours on the benefit of the death benefit, but I'm not going to here. I'm just saying our conversations occur every day, and what we see, what we experience, what we hear from clients, from prospective clients, from agents. Because, we speak to a lot of agents. We try to help everyone we can. We cannot help them all, but we make an effort to help where we can. But today was really going off of the idea of all this money up front. And I thought, in my mind, let's just look at the life insurance industry generally. Today, MEC is a topic, modified endowment contract. We typically structure policies within the infinite banking footprint to avoid the MEC, the modified endowment contract, because once a policy becomes a MEC, then it's always a MEC, can't be unMEC'd, and that changes the tax treatment, right? And the taxation on a MEC is LIFO, last in, first out. So it's taxable when you borrow money, withdraw money. And so if you can avoid it, Nelson said, if you can avoid it, you should, but a MEC is not the end of the world. Okay. But if we go back in time, I think it was 1988, and it's always a technical bill or adjustment to the tax code, right? Well, it occurs all the time, but I believe it was in 1988, and I could be wrong. It's 86. I believe it was 88. Whenever the IRS, came up with the MEC guidelines, right? And then there's a whole history behind that. We've talked about that on this podcast, and shortly, or just short order, back in the 80s. A lot of other things occurred too within the life insurance industry. There's a demutualization. These mutual companies were demutualizing into stock companies. There's lots of reasons for that. And a couple of them would be, all the Wall Street guys showed up and they want to run. The life insurance companies have all the money. Okay, they have all the money, and it's real money because they can't print money out of thin air like a bank. And so there's all these great, huge pools of capital. What Wall Street guru wannabe wouldn't want to get a hold of that? And it's going on today, and the current narrative is all the credit situation. Yeah. Okay, I don't want to chase too many rabbits. The bottom line is, back in the 80s, these mutual companies were demutualizing. There's several reasons. They wanted to compete with everybody else. You had Ralph Nader and all these do-gooders. I'm going to save the common man from these gangster capitalists, they're bad guys. You have the people that say, term is cheaper. Whole life is complicated and expensive and all these. I have a book over there. I mean, that argument, term versus whole life, is over 120 years old. It's nothing new, right? It was just, it has a new iteration or a new version, a new voice, as time goes through. It's all cyclical, right? But the bottom line here is all of these things are converging. The companies want to demutualize, and they're demutualizing because Wall Street people are coming in, running the companies. They want to get paid more, right? And they want access to all that capital and do all the things that shouldn't be done with life insurance company reserves, in my humble opinion. Then you have the Ralph Naders, like, life insurance is bad. But then you have Wall Street, right? We can't compete with life insurance, these single premium life insurance policies. They pay $100,000 in premium and 2 years away. In 2 years, you surrender the policy and walk away with $120,000 tax free. We can't compete with that. Neither could the bond portfolio, and so you have that fraction coming against them. And then, they go to court, the
Judas companies and
Congress looks into it, has all these hearings, they're all camera chasers in Washington. And so, in my humble opinion, the life insurance companies didn't even defend. They surely didn't adequately defend. They just capitulated because they want to be all things to all people anyway. And we're the bad guys. Oh my gosh. So anyway, that and some of this, there were some other court cases and big legislative changes in 1986. But I'm talking about, I'm pretty sure it's 1988 where the MEC comes in.
Do you think that was because of essentially the black eyes these insurance companies were taking for that's why they capitulated so quickly and so easily?
Well, they're tired of coughing up money just like they are now. And recently there's always lawsuits in the news, right? And the bigger the name, the more press they get, and
Kyle Busch, whatever.
And I don't know all the intricals, and I know there's lots of people out there jumping on that for clickbait. I'm not really interested, but at best, they got their actual money back. You put in 11 million, you lose 8, whatever the numbers were. They knew exactly what they were doing. I'm not saying they're bad people. I'm not saying the salesperson was a good guy or what. I'm not making a judgment call on that.
We're just not saying that the lawyers were not bad people.
Well, I'm not saying they were good or bad. I mean that. I don't want to go down that road.
Yeah,
everybody's trying to get clickbait material off of that and everything else that they think they can get clickbait material off of, which is fine. Okay. Modified endowment contract came from 1988 when all of these entities converge, beating up the life insurance companies. They didn't defend themselves, and the IRS said, put parameters on how much premium you can put in, how much death benefit it requires, and when you exceed these MEC parameters, what they came up with, then it changes the tax characteristics, the tax treatment of a life insurance policy. All right. Nelson said, if you can avoid a MEC, you should. But a MEC's not the end of the world, and I completely concur. May not be the best entity that you want to quote unquote control the banking function in your life with, but there, in my humble opinion, there's a place for modified endowment contracts. We can save that later for another episode. However, getting all the money in, single premium today is a MEC.
Yeah.
Right. If I'm going to go buy a life insurance policy and I want to put $100,000 in or whatever the number is, round numbers, easy math for me. Okay. If I put $100,000 in, it's automatically a MEC, modified endowment contract. Now I'll have a higher death benefit than I paid in premium, and I'll have cash value that'll be equal to the premium paid, and typically between years 3 and 5, and it continues to grow. It still earns dividends. It's a beautiful thing. Mm-hmm. But that might not be the best thing suited to practice the infinite banking concept with. All right. So there's my little background of the MEC.
Yeah.
All right. And so now here we are today in 2026, and people may not want to pay an ongoing premium.
Nope.
I don't want to pay $5,000 for the next 40 years.
There's just a way to do it, right? Because, what we're seeing a lot of is agents kind of doing like the minimum premiums or a smaller premium, annual premium or monthly premium as possible, and then these gigantic, lump sums into PUAs.
Yeah.
And that's just not the way to design that. There are ways to do certain things or to kind of give it the same kind of time schedule. Like, so there's like PDFs, PDAs, like I don't know what you want to call them.
Premium deposit fund, a premium deposit account. Most all life insurance companies have them, either one of them, whatever they call it. And most companies have more than one.
Yes. So whether it be a premium deposit fund or account, don't really care what you call it.
Just whatever you want to call it.
At the end of the day, you have a few options with those types of policies, with those types of riders, the PDF or the PDA. One of those options is to pay a large lump sum and have that distributed over a certain time period. So I don't know all insurance companies and what their regulations and rules are. I think it depends which ones, but a lot of them will do like a 3 to 5, 3 to 7, 3 to 10 year time period where you can essentially front load a premium. So let's say I do have a inheritance or a lump sum, a sale of a house, whatever it happens to be. I could put that full amount, let's say it's $500,000, into a policy year one and then never pay a premium again. That is absolutely possible. It just has to be structured differently than what we see.
Well, let's talk about that, because if I have $500,000, windfall, and I send the life insurance company the whole $500,000.
Yeah.
The whole $500,000 doesn't actually go into the policy.
That's right.
If it did, it'd be a MEC.
That's right.
Today's tax laws. So what you're saying, these companies have PDAs, PDS, premium deposit fund, premium deposit account. Mm-hmm. And the backstory to that is the life insurance company is giving their policyholders a place to put money to pay future premium. That's the whole design. The whole reason they exist.
What would you like in that account to?
What would I like in it? I would like a fair interest rate, and I would like it to bypass probate.
Well, I mean, liken it to
what would I liken it to?
Like a CD. What would you say it resembles mostly?
It would be something. It has some characteristics of a CD or an interest-bearing account.
Yeah.
Right. And most of the time, well, if a life insurance company has more than one PDF, one will pay a more modest interest rate, and the other would pay a higher interest rate or a higher discounted interest rate equivalent.
Yeah.
That's designed specifically to go into a particular policy design. Yeah. Right. And so I would liken them to a CD in the fact that once you put the money in, there's a time period.
Yeah.
Right. Whether the policy is designed to take premium from the PDF over 3 years, 5 years, or 10 years. Most of the companies have a limit on this type of design. And if I get mad and quit, then I lose the interest that I could have earned. Right. And there's not really a penalty like a CD. Like if I leave a CD early, then the penalty could be I don't get the interest.
Any interest, yeah.
Right. And then there's that time element on there. The high interest savings account equivalent or comparison would be I just earn a higher interest rate than I would in just a regular savings account.
Yeah.
But when I, and I have hearing deficits. So when you ask a question, what would I like? I'm telling you what I would like.
Yeah.
Is a fair interest rate.
Yeah.
And that money to bypass probate.
Yeah.
Right. Because if your money's in a bank or the CD, it may or may not bypass probate. Depends on what you've done. And there is a way for you. There's actions that you can take to make sure that money bypasses probate. In a PDF account, premium deposit fund account with a life insurance company, the money's not in the life insurance policy and it's totally liquid upon my death, but it also bypasses probate. And so that's a long answer to your question, but
I love it. And look, the different, right, the way you set it up, it can be very different, right? It's not for everyone, that's for sure, right?
Well, who would it be for? And I don't want to throw you off. I mean,
the people it would be for are people with, either who've recently received inheritances, they've made a large sale of a property, people
they've got
who
a chunk of money.
They have a chunk of money, but maybe necessarily they don't want to pay a premium annually.
On an annual basis.
Or, maybe ever. Maybe they want to pay one premium and just be done.
Yeah.
And so single premiums historically have been that product, but as people in the IBC community, and we've just, discussed, those are going to be MECs. Those are going to be modified endowment contracts.
And so within the IBC, I love this because within the IBC community, they avoid a MEC, the typical agent, advisor, and they think they're doing the right thing. Yeah. It's like, okay, well, we'll just... I call them Frankenstein policies. If you've listened to this podcast over the last 6 or 7 years, I've talked about structure till I'm blue in the face. And anyway, the agent or advisor tries to structure the policy to take as much of that lump sum. The terminology is egregious in my opinion. Front load, overload, dump in, all this stuff. But the bottom line is they're trying to get as much money into a policy as possible, as early as possible. And you have to contort the structure of the policy to the point in which you are jeopardizing the long-term stability of the policy. Period. It's just period. Give it time. You'll see if you do it and you can disagree. No, James, I have a 90-10 policy and I'm in my 5th year and I don't have any problems. Well, keep going, brother. Look. And
fair.
I had a client call yesterday and it's a client that I've inherited. I've worked with agents over the last 35 years, work with about 20 agents roughly across the country, support them, mentor them, and this was one client of a previous, agent that kind of, you touched all over the characteristics. He became a client. He's a friend today, right? I invite him to the pool parties and he's a cool guy. He was very successful in his profession. He became a client. He met Nelson. Him and Nelson became friends. So he's like, oh, I want to be an agent. He did refer clients, not very many, but he's like, no, I want to get paid for it. Well, of course you want to get paid for it, right? Which, no problem. Okay. But then you talk about 90-10, he delivered policies that were 96-4, right? And these are 15 years ago. So I appreciate all the help that people want to educate me, and I'm absolutely teachable. But I don't need any more help understanding how bad or how good 90-10s are. I don't need to revisit all that any more than I do.
But James, I've been an agent for 3 years and I can illustrate on the illustration software that nothing goes wrong.
Yes.
Oh, what do you mean?
Yeah, well, my illustration doesn't show a MEC, right? So, and my point here is, it's a lovely gentleman I've inherited, so he was never orphaned. But here, 15 years later, you've got a 90-10 policy. Or actually, that was, like I said, 96-4. But, and he has not been harmed, right? As a matter of fact, he's in a good position because of the support that my office has provided him and his family over the 15 years.
And a bit of good luck, too.
Yeah, but then that kind of thinking, the 90-10 thinking, or the real low base, get all the money in, has results. And that thinking generally continues, or it doesn't, right? If it does continue, you can just see what actions are going to occur in the future. If it doesn't, that thinking doesn't continue, and the client's like looking at what's going on, it's like, oh my gosh, no, the next policy I want, why can't it be all base? And I want a much larger base, because they're doing it. They're actually doing it. They're actually controlling the banking function. They're actually participating, applied the infinite banking concept, the idea of becoming your own banker into their lives, right? And they get that experience from that. And therefore they see the action of the policy, and they haven't bought into that short-term kind of thinking, I got to have everything right now, and therefore, I've got to max out the loans and not repay the loans, not pay the interest, and all of that. So there's two outcomes in my experience of that. And the third outcome, of course, is like, you know what? This is not what I thought it was. This is not what I expected. So I'm just going to get mad and quit. Okay. I don't want to throw you off.
Yeah.
But the getting all the money in and not becoming a MEC generally requires a lot of manipulation to a policy that's not going to serve the client well over time.
Yeah.
And then what you're saying, though, no, there is a way to properly do it.
There is an absolute way. There is absolutely a way to do it properly. And using those PDFs or PDAs, that's the way to do it. And it's to essentially get that same premium over whether it be a 3, 5, 10, 7.
Whatever it is.
I'll tell you, I'm a fan of the longer you do it, the better the outcome is. So, I mean, if you were to create a list of pros and cons for the PDAs and the PDFs, right? One of the big, I guess, pros is the improved cash value growth. Because they are paying that additional premium, whether they call it premium discount, whatever their terminology is.
That additional value is going into the policy as premium
that the life insurance company is paying.
Well, because
of that
values of the
account.
So if I put in $1 million and I want to pay $100,000 over 10 years, but I don't actually want to do that. I've got $1 million today. I want to do that today. I don't want to out of pocket pay future premiums.
Or you're just trying to get the biggest bang for your buck on that.
Right. So I send the company $1 million. And then in this case that we're talking, $100,000 would go into the policy in year one. Then that $900,000 remains at the life insurance company and either has a discounted interest rate, an interest rate equivalent, or an interest rate, whatever you want to call it, however it's designed. It's taxable because you get a 1099 each year on that value. Right, that was generated. But then in year two, maybe $115,000 goes into the policy premium. Right. So if I sent $1 million, it wouldn't be, I'm dividing that up by 10. It wouldn't be 100,000. It would be a greater number than 100,000 for an annual premium because of the premium deposit fund.
So it would be like I pay in, $1 million and I've set it to do $100,000 a year, essentially for 10 years to get the $1 million. But the insurance company's also paying a percentage. So maybe it's like you said, maybe it's 105 each year or 110 each year.
Yeah, whatever it is, it's a greater number than 100.
Absolutely. And that difference is the life insurance company, what they're paying essentially on your behalf from the account. So again, they keep it separate because they have to. You can't commingle those funds.
Right.
It's like, it has
it's not in the life insurance policy.
Exactly.
It is a premium deposit account or a premium deposit fund. It is sitting there doing what it's doing to pay a future premium.
That's right. And then the interest that's earned is usually paid via a discount or whatever they call it. There's terminology for each of them. But essentially they're paying that for you.
Yeah, that's a taxable value.
It is taxable. But the taxation on it is also minimized in how they do it.
I'm bringing that up because a lot of times people will say, well, why do I pay taxes on that? Well, because all the money's not in the policy. And if you had $1 million and you put it in the bank or you put it somewhere else, that tax character is going to be whatever that tax character is, wherever the money is. And this account is going to be taxable.
And the fair question is, well, why don't I just keep it in a CD or keep it in an investment?
CD interest is taxable too.
Absolutely. Well, maybe I can earn something, a higher interest rate. Again, Nelson touches on some of this, but
rate versus volume.
But maybe I could earn, more in, the market right now.
Maybe you could.
But it's also a way to supercharge the policy. And when I say supercharge the policy, I mean, the life insurance company is paying premiums that you're not. And the way they're doing it is increasing your cash value each and every year.
Yeah, because they're doing it. Yeah. Well, and two, you bring up interest versus volume.
Yeah.
The rate is the rate. So whatever the premium deposit fund rate, interest rate may be, right? Whether it's a discounted interest equivalent, whatever the term, it's a taxable value, right? But then as it into a properly designed policy, and I say properly designed, that meets your financial situation, your goals and timelines, it absolutely has or is a great case, example, a data point, comparison, rate versus volume. So you might get a discounted 4.5% equivalent, right? That's taxable each year in year 2 through 10 in this case. You get the 1099. But then that is premium to the policy, and then you use the word supercharge.
Yeah.
I'm just pointing out there's the rate, no question. We can all calculate a rate, but then look at the volume of premium it does to that policy over a 10-year time period. And you can see the greater volume in year 1 in the cash value, and in year 2, the cash. I mean, there's a interest versus volume argument or case.
I would argue that either way you argue it, you're right when it comes to like the PDA or the PDF, like however you do that, because the rate is also higher. Like you break even, you break even earlier. So when I say break even, I'm talking about when your cash value or your loan amount available, whatever you want to call that, equals or exceeds what you've paid in premiums total.
Cumulative premium, cumulative cash value.
Yes. So when that is exceeded, that happens quicker with a PDF or a PDA. That is honest. Is what would you say the most efficient way to get that money in is to use a PDA or a PDF. So if I had that $1 million and I paid it out over 10 years, right, into my policy, you can do that. But a more efficient way would be to use the PDA or the PDF Max. Now, if this is like $1 million, I need this money immediately to go spend. This is not what the PDA and PDF's for, right? If like my whole thing is, I came into $1 million and now I want to go buy real estate with that money, right? Should I put it all into a policy, then take that money out and go buy the real estate property? Or should I just pay cash for the real estate property and then pay premiums of what I can?
Well, could I go to the bank, another bank, and collateralize? Because you cannot, with the life insurance company, borrow against a PDF balance, right? Because it's earmarked for future premium. And you can get mad and quit. So the life insurance company is not going to lend money on that when you can get mad and quit.
Yeah.
Right? And just say, hey, I want my money. Okay. So could I, I put $1 million in. Yeah. I'm in year 2. I have whatever $825,000 left in that PDF, that side account there, earmarked for future premium. Could I take that account balance and go to a third-party lender and borrow against it? And I'm not answering that question, and you don't have to either.
Yeah.
I'm just saying
it's possible.
Can I can collateralize any asset that I can contractually collateralize, right?
Talk to your banker.
Yeah, so your point is that you send $1 million in this case, you cannot borrow against that whole $1 million from the life insurance company.
That's right.
Right. So if you're going to do real estate or make a major purchase, you're only going to be able to borrow the cash value, a part of the cash value that is available in whatever year of the policy that you're in. So, right?
But James, why can't I just do, a low initial premium with a gigantic PUA and get the full $1 million in and then pay like, $10,000, in premium per year?
Well, it could be done with a couple of companies. Yeah, it could be.
There's no issues with that?
I think there's a ton of issues. I mean, do you want to cover them all here?
Let's cover some of them.
Well, let's cover some of them.
My
the
gosh.
amount of death benefit that's required to do that. So whether you have a PUA, that's where all this additional premium front-loaded dump in, whatever the language is.
Yeah. And then,
so if I have $1 million, a 1090 would be I have $1 million base premium, but I don't want to do that. So let's say I go down to a $50,000 a year base and have $950,000 into a PUA. I got to buy a tremendous amount of term to avoid the MEC to make that happen.
Yeah.
Right. And then typically in the big wild world, there's two structures. What we tend to do is use a separate standalone term rider on a policy to make that happen. Mm-hmm. Right. Well, all that term rider costs a lot of money, and there's so many reasons we do the things we do the way we do them. And absolutely believe they're correct. That's why we do them. And not going to do the things that we don't believe are correct. And they're happy to explain why or why not. Not interested in debating, agents that are like can't get off a 90-10 and want to make everything personal. It's like, man, you go do what you want. Okay. There's an extreme amount of term that I have to purchase.
Yeah.
and I have to keep that on there for a certain time period, even the way we do it, right? If it's separate standalone. But then the other option is I'm going to go get a blended PUA, where the PUA is accepting that premium, that $950,000, but internally it's blended. So internally what's happening is that PUA rider is blended with the term component. And there's a couple of variations out there.
Yep.
And if the listener in your mind, you can see an exponential curve, right? That's exactly what happens to any account that has interest, a value, and time. That's also what happens in your lifetime. We all have one exponential curve in our lifetime. But that's also what happens with this term component. It could be a level term, right, within the blended PUA. So you're paying this premium for a level time period, and it could be 10, 15 years, right? Or there's the equivalent of annually renewable term, and that's where the exponential curve comes in. Okay, and so now I may be getting too deep into structure, which I don't really want to, but now the dividend is allocated to pay that increasing cost of the term. And if the dividend is not sufficient to cover that increasing cost of term, then it comes from the PUA cash value. Now these companies will say, that's convertible. No, that's not convertible.
What if I borrowed that money out? Because look, that was the whole idea, James, is I wanted to take that $1 million, I wanted to put it into a policy, take $900,000 out, go buy whatever property I wanted to, and then, hopefully you as the agent and advisor have told your client they need to pay those loans back. Obviously, a lot of people don't. Or that's not even the intention, is like, I'm going to, put $1 million in. That's
that new idea of buy, borrow, and die, Well, my point is, I'm just saying there's several reasons why I wouldn't want to do that.
Yeah.
Okay.
There's
now,
tons.
If I'm able to pay $1 million and I don't want to pay continuing premiums.
Yeah.
Excuse me. I just want to do it one and done, and I don't want it to be a MEC. And this idea looks good to me, and it really does look good. So I do that. But then I want to go buy a piece of real estate. Now, I can go borrow, like you initially said. I could go borrow from the third-party lender, and then over time, that would be the first debt obligation, or one of the first ones that I would take over as I'm practicing becoming my own banker. And I'm really okay with that, right? See, I'm all for being free and independent of bankers, and we kind of alluded to it, or even talked specifically about some of the other topics that we're going to talk about in the future, that premium equaling income. Nelson says it takes the average guy 20 years. It took him 14 years to get rid of the snakes and dragons. He talks about why he doesn't start with taking over, a mortgage when you're getting out of debt. So Nelson has a lot to say in there that's been misconstrued and misapplied in practice.
Yeah.
So if I wrap that up, I don't want to be part of the problem, borrowing money that didn't exist and then paying interest on that. I don't want to participate in that at all. It's taken me a long time to get out of that situation. Mm-hmm. However, if it's going to take me, if I just learned about the infinite banking concept relatively recently, and all of that is very appealing to me, premium equaling income, how do I get all my money into a policy? That might make sense to me, right? This contorted policy and what have you. But the deeper you look at it, in my opinion, when you understand what's really going on with dividend paying whole life insurance, you wouldn't want to do that, right? Because you're thinking short term, and these policies, the longer they're in existence, the better and more efficient they become. When you understand that, if you're going to put a lot of money, time, effort, and energy into anything, don't you want it to get better over time?
Absolutely.
All right. And so...
And how do these policies function the best? They function with level premiums over longer periods of time. So if I'm starting off with year one, $1 million in premium, year two, I'm going down to 10,000 or whatever I can afford, and that's the premium level from then on. It's like, that is a very inefficient policy. Like,
but in the early years, it looks great because you had access to $950,000, and then
I may even break even in 5 or 6 years, which looks great. But it's the future gains, the future earnings on that policy have been muted. They've been absolutely destroyed.
When you
comparatively.
Typically, somewhere around year 9 to 14, 11 is coming to mind. Then it becomes clearer and clearer the further you go. Yeah. And that's just on an illustration that was ran today that's wrong as soon as you push print, right? And if the dividend's not paid as illustrated, there's so many other things. I love these letters you get with a blended PUA in year 3. Well, the dividend wasn't sufficient to pay the term cost, so either the term cost is going to go down or you're going to have to send in X number of dollars. So your dividend already paid the increasing cost, and now you got to send more money in. If you don't, the PUA ability that you have in the future goes down. That is a slow path to zero. Not zero, but that's a slow path to complete inefficiency.
No, you're right. It is. It is a
my
path
dividend
to zero.
didn't go to the PUA to buy additional death benefit, to earn additional interest.
So what were the two options again?
To earn additional dividends.
There's several options. So either you surrender PUA premiums that you currently have, current cash value that you have to pay that difference. You pay a higher premium because, well, that's what's being charged. Like your term is higher than what they're paying for. So either you pay it via surrender or pay it out of pocket. Yeah. Or the third option, you limit the death benefit goes down, right?
And your ability to pay PUA goes down as well.
Well, what can happen if my death benefit goes down? Because a modified endowment contract happens and your cash value and your death benefit are too close I don't want to say in an early year, but that's usually when it happens. That's usually the
typically.
effect of that.
I haven't seen these. I haven't seen blended PUAs become a MEC in the early years.
It's the latter years.
It's the latter years.
Yeah.
And,
but that's a risk when your death benefit starts reducing. Like you're just getting closer to that MEC line. You're getting closer to MECing that policy, and it just makes it easier to MEC.
I know I feel like sometimes I throw out carrots, which unintentional.
Yeah.
I've got all these different modules. I'm always working, right? Mm-hmm. And in the future, there is going to be like a PUA 4. I think I've done a series on PUA. I've talked about PUA a lot. But anyway, in the 4th PUA, I'm going to specifically talk and demonstrate, right, with all the little, visuals, documentation, blended PUAs and what really happens, in the 10th year and the 15th year, right? And it's, what I'm saying is true. What you're experiencing in the early years, you may not can see, and it's difficult to see inside of a blended PUA anyway. Wonder why. I'm not saying that's intentional, but I'm not saying it's not, by the insurance company. And I think the insurance companies are just putting these products together to, fill the perceived need of the marketplace, right? And so when you have agents that sell them and promote them and people that buy it, that's a signal to the life insurance company that, we can make money on this. It's a good product. Let's, internally, what happens even in a blended PUA because of the rising cost of term. And when you see what's going on, if you would have known better or would have known different, you would have done something different, in my humble opinion.
A lot of those
could be wrong.
No, a lot of those blends to me more resemble a UL, universal life policy, than they do traditional, or what I would call level premium whole life insurance. Yeah. So level premium whole life insurance, not saying you can't raise and lower premiums, just the costs aren't going to raise and lower. On the PUA, the term, the base, none of those internal costs are raising. So level premium. And that's the effect of it, is it's a level premium, what you can pay, that maximum premiums level. It's not going to increase in the future because of a term cost internally, like with whether a 1-year renewable term or Universal Life would call a cost of insurance, a COI. So, but they function very similar to me because the problems are very similar. Not only the possible eating of current cash values, but possibly the raising of premiums, possibly the surrender of policies. What happens when I'm 20 years out into a policy? I'm max loaned.
How about I'm 60 and I'm not max loan, but I got an IUL? How many of them do you want to deal with?
None, but specifically in both of these cases and scenarios, whether it's the IUL or it's the blended term, if I'm at let's say age 60, let's say I have a lot of my outstanding loans already going, so I've taken a large amount of my available loans, so I've already used those. What can happen if that cost goes up and it's not covered by the dividend, or just the COI, the cost of insurance and a UL goes up? Yeah. Couple of things, right? If that difference can't be met by the dividends or the earnings of that side account, right? Either you're going to pay for it, and if you can't afford it, it's going to surrender PUAs. Well, what if you don't have the PUAs to surrender?
We're going to stop here and continue the conversation in the next episode. Thanks for listening.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.